Hey, deep divers. Ready to tackle portfolio risk and return? You guys really outdid yourselves sending over all this research. Looks like someone's serious about mastering their investments.
Well, it's definitely not a game out there, that's for sure. But honestly, it's pretty fascinating stuff once you get past all the financial jargon.
That's what we've got you for. And judging by what you sent over, it looks like you're ready to build that dream portfolio. You even included some stuff about this risk-free asset. Is that even a real thing? Because if so, sign me up.
Haha, I wish it were that simple. Unfortunately, there's no magic asset that completely eliminates risk. It's more about having a strategy. Think of it this way. You've got your risky assets, your stocks, bonds, maybe even a little crypto sprinkle if you're feeling adventurous.
Okay, I'm following.
But then you got these ultra-safe havens, like U.S. Treasury bills. Those are what we call the risk-free assets.
So basically, I'm trying to find my own personal risk comfort zone by mixing and matching, right?
You got it. It's all about finding that balance on the risk-return seesaw. If you're more risk-averse, you'd lean a little heavier on those Treasury bills, feeling bold. Then you amp up those riskier assets.
Okay, that makes sense. And this is where that whole efficient frontier concept comes into play, right? The one we've talked about before.
Exactly. Remember how the efficient frontier maps out the portfolios that give you the most return for a certain level of risk? Or the least risk for a target return, if you prefer?
Right. I remember.
Well, when you add a risk-free asset into the mix, you actually extend that frontier even further. And this creates what we call the capital allocation line, or CAL for short.
So it's like upgrading to a fancy GPS for my investments then. I like it. But what about this capital market line I keep seeing? That sounds pretty official.
That's like the VIP section of the CAL. The capital market line, or CML, assumes that everyone agrees on what the ideal risky portfolio is, something like the S&P 500, for example.
So it's like investing in index funds that try to match the S&P 500.
Exactly. But keep in mind, the real world is a little messier. Just like those differing analyst opinions on Siemens we talked about, not everyone's going to agree on what that ideal portfolio actually looks like.
Oh, yeah. How could I forget? Different valuations, different outlooks. It's like everyone's got their own crystal ball.
Right. Now, on the complete opposite side of the spectrum, you've got folks who like to live on the edge a bit with leveraged portfolios.
Leveraged portfolios. I'm getting some serious high-stakes poker game vibes from that name.
It can be a bit of a gamble, that's for sure. You're essentially borrowing money to pump up your investment, which means amplified gains, if you're right, but also amplified losses if things go south.
High risk, high reward. I feel like that's a common theme here. But this is making it crystal clear why understanding risk is so important in this whole investing game. But how do we even begin to measure something as unpredictable as risk?
Million-dollar question. Luckily, finance has a few tricks up its sleeve. We can actually break risk down into two main categories: systematic and unsystematic. Think of systematic risk like the tide. It impacts everything in the market.
Okay, those are the big things I can't really control, even with the best forecasts in the world, right?
Good.
Like interest rates, inflation, even a global pandemic.
You got it. Those are the things that keep even the savviest investors up at night. And here's the thing. You only get rewarded, in theory, for taking on that systematic risk.
Wait, really? So if my portfolio takes a hit because interest rates suddenly spike, I'm supposed to get some kind of bonus for sticking it out?
Not a direct bonus, no.
Yeah.
But the idea is that since you're exposed to those unavoidable market forces, the market should reward you with higher returns over the long term. At least that's the theory.
Interesting. Okay, so then what about that other kind of risk, the unsystematic kind?
Now that's where things get a bit more strategic. Unsystematic risk is more like a company-specific drama. Maybe there's a product recall, a scandal, or a sudden regulation change that only impacts their specific industry.
So that's the type of risk I could potentially avoid if I diversify my investments,
Yes.
right? Like my grandma always used to say, don't put all your eggs in one basket.
Your grandma sounds like a wise woman.
Yeah.
Because you can diversify away that company-specific risk, the market doesn't usually reward you for holding it. It's all about making smart choices.
This is fascinating. It's like I'm finally starting to understand how this whole investing game really works.
And understanding these different types of risk is absolutely essential for everything else we're going to discuss. But before we jump into how we can actually try to predict these returns, what stood out to you most about these different flavors of risk?
Yeah, that was a great breakdown of the different flavors of risk. I feel like I'm really starting to see the bigger picture. But speaking of seeing things, what about those return-generating models we saw in one of the articles? Sounds pretty intense. Are we talking like top secret Wall Street algorithms here?
Huh? Not quite as mysterious as they sound, I promise.
Yeah.
They're basically just tools that use data and analysis to try and predict potential returns, like a financial forecast. But instead of relying on tea leaves or something, we're looking at things like economic indicators, historical data, and how companies are performing.
So data-driven forecasting. Got it. But how do these models actually work?
Well, there are a few different types. You've got your multi-factor models, they're kind of like the overachievers, taking into account tons of variables like economic growth, interest rates, even company-specific things like earnings reports.
Okay, I'm with you.
And generally, the more factors you consider, the more accurate the prediction can be. But sometimes a little simplicity can be a good thing too. And that's where the single index model comes in. This one focuses on just one main driver, the overall market return, often represented by something like the S&P 500.
So if the S&P 500 is predicted to go up, the model suggests my investments will too.
Generally, yes, especially those investments that are closely tied to the market's movements. And this brings us to a very important concept you'll see everywhere in finance: beta.
Ah, yes, beta. That one kept popping up in my research too. I'm getting the feeling it's kind of a big deal.
It is. You can think of beta as a way to measure how sensitive an asset's price is to the overall market. So a beta of 1 means it tends to move in the same direction and at the same pace as the market. A beta of 2 means it's twice as volatile, and so on.
Got it. So a high beta stock means it's going to be a wild ride, but there's potential for bigger gains and bigger losses too.
Exactly. And all of this ties directly into expected returns. Generally speaking, those high beta assets that have the potential to swing more dramatically are also expected to deliver higher returns over time. Remember how we were talking about systematic risk? Well, beta is basically how we measure that.
This is starting to make a lot of sense. Basically, the market rewards you for embracing that unavoidable systematic risk by giving you the potential for higher returns. And beta is how we figure out just how much risk we're taking on.
You got it. And this leads us to perhaps the most famous formula in all of finance, the capital asset pricing model, or CAPM. It essentially uses beta to try to pinpoint what an asset's expected return should be.
The CAPM, it did seem kind of magical, like this single formula holds the secrets to the investing universe.
Well, it's definitely a cornerstone concept.
Yeah.
But to put it simply, the CAPM says that an asset's expected return equals the risk-free rate of return. Remember those treasury bills we talked about? Plus beta, which represents the systematic risk, multiplied by something called the market risk premium.
Okay, hold on. Break that down for me. What's the market risk premium?
Basically, it's that extra return that investors demand for taking on the risk of the market as a whole, compared to just playing it safe with a risk-free asset. You can kind of think of it like a bonus you get for venturing into the stock market instead of keeping all your money under your mattress.
Got it. So the higher the risk premium, the higher the potential reward, but also the higher the risk.
Catching on. The CAPM really tries to capture that dance between risk and return. However, like any model, it does make a few assumptions about how markets work.
And the real world is never as clean and predictable as our models, right?
Unfortunately not. For instance, the CAPM assumes that markets are perfectly efficient, no transaction costs, everyone has access to the exact same information instantaneously, that kind of thing. And in reality, we know that's not always the case.
Definitely not. But even if it's not perfect, it seems like a valuable tool for at least getting our heads around this whole risk-return relationship.
Absolutely. And it leads us to another incredibly useful visualization, the security market line, or SML.
More graphs and charts. You know I love these.
I had a feeling you might. Well, the SML is essentially the CAPM in visual form. It plots the expected return against beta. And anything that falls above the line could indicate an asset that's undervalued, and anything below might suggest it's overvalued.
So it's like a cheat sheet for potentially finding those hidden investment gems.
In a way, yes.
Yeah.
It's all about finding those opportunities where you believe the potential rewards outweigh the risks. But remember what we talked about earlier, how the CAPM isn't perfect? Well, because of some of those limitations, people have come up with alternative models to try and capture a more realistic view of the market.
It's like an ongoing quest to build the ultimate financial model.
I like the way you think. One pretty well-known alternative is the arbitrage pricing theory, or APT. And instead of just beta, it considers multiple factors, things like inflation, interest rates, even industry-specific risks.
It sounds like it's trying to account for a lot more of that real-world messiness we were talking about.
Exactly. And then there are models like the Fama-French three-factor model, which throws in company size and value as additional factors that can influence returns. But ultimately, Every model has its own strengths and weaknesses, so it's all about finding the right tool for the job.
Right. So no single model holds all the answers, but they all try to shed light on this fundamental relationship between risk and return.
Exactly. And speaking of putting this knowledge to work, let's talk about how we can actually evaluate how our portfolio is doing. Because if we're taking on all this risk, we want to make sure our investments are actually performing, right?
You know it. Time to separate the portfolio superstars from the underperformers. All right, let's talk about those evaluation metrics. Time to find out which investments are the superstars and which ones are lagging behind.
You got it. Let's start with a classic, the Sharpe ratio.
Okay, tell me more.
It basically tells you how much extra return you're getting for each unit of risk you take on. So think of it as a measure of risk-adjusted return. And a higher Sharpe ratio generally means you're getting more bang for your buck, so to speak.
Risk-adjusted returns. Now you're talking. What else is there?
Well, there's the Trainer ratio, which is similar to the Sharpe ratio, but it focuses specifically on that systematic risk, the market risk, that we can't really diversify away.
Right, right.
Though instead of using overall volatility in the denominator, it uses beta.
So it's like a focused look at how well my portfolio is handling those big market swings, right?
Exactly. Then we have M2, which compares your portfolio's return to the market's return, but after adjusting for risk. It's a way to level the playing field and see how your portfolio stacks up against the market when both are taking on the same amount of risk.
Ooh, head-to-head competition. I like it.
And last but not least, there's Jensen's Alpha. Remember how we talked about that with the security market line?
Yeah, it sounded pretty important.
Well, it basically tells you how much your portfolio's return exceeded or fell short of what would be expected based on its beta and the market risk premium.
So it's like a report card for my portfolio manager to see if they're actually delivering those returns, right?
Exactly. Now, all of these ratios are essentially trying to answer the same question. How well is your portfolio actually doing relative to the risks it's taking? They're just using different lenses to give you a more complete picture of the situation.
I'm loving all this. But how do we take all of this theory, all of these ratios and models, and use it to build a killer portfolio in the real world? One that actually matches my risk tolerance and helps me reach my financial goals?
That's the million-dollar question. But there's another helpful tool called the Security Characteristic Line, or SCL for short. It's kind of like the SML we talked about earlier, but instead of plotting expected returns, it charts the actual historical performance of a security or an entire portfolio against the market.
Oh, so it shows how the investment has actually performed in the real world, right?
Exactly. And the slope of the line gives you the beta. But what's really interesting is the intercept can actually point to potential investment opportunities.
Wait, really? Tell me more about that.
So let's say you're doing your research and you have a hunch that a certain stock is undervalued, but the market doesn't seem to agree with you yet.
Okay, I've definitely been there.
Well, the SCL can actually help validate or invalidate your hunch. Because if you're right and your analysis is sound, the SCL should show that with a positive Jensen's alpha.
Wow, that's powerful stuff.
It is. But let's not forget about our good friend, diversification. It's super important to spread your bets across different investments to manage those companies' specific risks.
Right, like that saying, don't put all your eggs in one basket. But how do I go about actually building a diversified portfolio? Like, how many different stocks should I have?
Well, you don't necessarily need a tiny piece of everything out there. Research has shown that a well-diversified portfolio of around 30 different securities can actually be very effective.
So quality over quantity, then.
Exactly. Think about different asset classes, different industries, maybe even different geographical regions. The key is to create a balanced mix that helps reduce your exposure to any single source of risk.
Makes sense. So when I'm looking at an investment, I should be thinking about its beta, its Jensen's alpha, its overall risk profile, and then I need to make sure those risks are balanced out across my entire portfolio. Did I get that right?
You nailed it. And keep in mind, diversification isn't something you do just once and then forget about it. It's an ongoing process. Markets change. Your own personal goals and risk tolerance might shift over time. It's important to stay vigilant and adjust your portfolio accordingly.
Wow, this entire deep dive has been incredible. I feel like I've learned so much from understanding all those financial models to knowing how to actually evaluate my investments.
I'm thrilled to hear that. Remember, though, this is really just the beginning of your journey in the world of investing. So keep learning, keep exploring, and don't be afraid to ask questions.
You've got it. And for our listeners who want to dive even deeper into this stuff, we've included some really great resources in the show notes. So don't be shy about checking those out and then hitting us up with any questions you might have.
We're always happy to help guide you on your path to financial success.
And there you have it, your crash course in portfolio risk and return. Armed with all of this knowledge, you're ready to tackle those investing decisions with confidence. And until next time, keep diving deep, keep those questions coming, and keep building the financial future you deserve.